Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, and I hope you had great holidays.
Hey, Jim. Yeah, it was good. Weather was lovely. Worked just about every day, but that is the nature of the work that I do. So as long as you can do it from a nice location and still get outside of it, you're happy enough.
Two polls showing just how tough it is to live in the world's third most expensive city, Vancouver. Young people with families say they plan to move out within the next 3 years. They just can't afford to live in Vancouver. And a nationwide survey of 18 to 34-year-olds found they feel they have no control over their financial future. Well, first of all, what about the housing problem in Vancouver and Toronto?
Yeah, so traditionally the way that is corrected is by people leaving areas and migrating to somewhere where they can afford housing and where jobs are more available. So it's supposed to prompt an exodus of sorts of people. And I think that will very likely happen. I mean, if people cannot or do not wish to continue living with their immediate family as, you know, they get into their 20s and 30s, most will have to find alternative locations to move to. And that's probably one of the self-correcting mechanisms that will help to bring, you know, property values back down again. Again, you're going to have a bunch of boomers in the next 10 and 20 years sitting there with too much house. And they're going to be looking for who can take it off their hands. And this steady flow of foreign capital and money laundering money seeking to come into North America from Asia and other locations is not going to be indefinitely there. So at some point, you know, I think it's like Wile E. Coyote off the cliff. You know, you're looking around for buyers and they've sort of evaporated, and the people that should be there in line, like the next up-and-coming generation, will have, you know, moved to other places. So, as I say, it's typically self-correcting and is part of the cycle. I just think this time it's been so pronounced. It's kind of like, you know, extreme housing makeover. We've had extreme housing pricing, and I think that the downside of that is it's going to be a longer cycle and probably a deeper cycle to try and mean revert back to value that people can afford.
The province has given the city of Vancouver permission to put a tax on vacant homes. Surveys find that about 10% of homes in Vancouver are vacant at any one time. But I can see a workaround that bylaw. Just say you're renovating the house. There's no deadline on doing renovations. There are houses in Vancouver that for the last 20 years have been, quote, under renovation.
Right. And I don't think it would really address the problem of people being sort of planted in these properties, so-called students and people that aren't actually, you know, earning income in that area, and that wouldn't be considered an empty house, right? So I'm not sure. But anyway, I think the impetus to do more regulation of who is allowed to buy and how long they're allowed to hold, and to a real simple thing, Jim, just real simple, would be stopping this ability to flip contracts, you know, to buy and sell land contracts before you complete them. That whole flipping business is totally non-productive. This is tulip mania. This is South Sea bubble stuff. This will go down in the history books as the, an epic cycle of self-destructive behavior, and that's the kind of stuff. It really serves no purpose. It looks fancy on the way up. It looks like prosperity, but because nothing is actually being invested in productive activities, it doesn't create any wealth. It's just a fleeting, vision that vanishes.
What about these poor people I see on weekends out in the suburbs of Vancouver lining up for hours in the rain to go and buy a townhouse that's tall, skinny, really cramped? There seems to be a real panic out there.
Yeah, and whenever you're panicking to buy something, you should have some kind of gut instinct that says to you, this is not the right time to be buying. Whenever there's a panic to buy, you know that that's a danger sign, and that's certainly the case here. So, the other thing is a lot of Americans, whether they have the money or not, are, of the mindset that you carry mortgages. They still think of, money from the bank as somehow other people's money, when in fact it's just loaned against your equity, charging you interest. So I'm always amazed, how many people, even in the investment industry, will carry large mortgages all the time, which just really tells me that they're not very astute financial managers themselves, and yet they're advising others on how to do this. When you've got non-productive debt, when you've got non-tax deductible debt, which is essentially anything that comes from consumption, including housing, because housing at the end of the day is a shelter, a personal shelter, and it is nothing more really, but we've turned it into this whole, massive industry of, quote, investment. And I think that's the part of the puzzle that gets everyone into such trouble. This idea that they're somehow, quote, getting rich off of speculating in these things. So, yeah, it's there's more debt in the world today than there was in the Great Financial Crisis by a long shot, and that will continue to slow growth. It will continue to make sales decline, and we're already at zero rates everywhere, so there's no more bang for the buck coming from a drop in rates. You've got the yield curve flat basically across North America, and negative rates in $13 trillion of government bond markets around the world. We've got the Bank of Canada's that's a Freudian, the Bank of England's Mark Carney this week not raising rates today, but not cutting English rates today, but saying that they're going to look at more ways to, quote, stimulate this summer. And you've got the Bank of Japan promising to buy even more stocks. This is just, as I say, an epic period that will go down in the history books as one of the most reckless, wasteful eras in human history.
We'll have more with Danielle Park right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, one of the headlines on your blog, Juggling Dynamite, had a headline saying the end of alchemy. What does that mean? Merlin's dead?
That was Marvin King, the former head of the Bank of England, who was at the helm in the financial crisis of 2008, wrote a book called The End of Alchemy. And Michael Lewis, who is another favorite author of mine, came from, originally had Marvin King as a professor of his at the London School of Economics. Before he became a world-famous author, he worked for a time on the bond desk of Salomon Smith Barney. And he got there by coming out of the London School of Economics, and he wasn't long in that seat before he realized what a corrupt and disdainful business it really is. And so he left to go and write about it, and the rest is history. But his review of Mervyn King's new book, The End of Alchemy, is really worth reading. So I put a link to that, and he called it the book that will save banking from itself. And essentially, it's just another version of how to accomplish a Glass-Steagall-like division between the selling and the advising side of the finance business. And, I've been saying for forever that we need to bring back hard divisions that stop salespeople from marketing themselves as advisors, that stop banks from being able to cross-sell products against the security of bank deposits. This is how we got into this terrible mess. And so Mervyn King is proposing another way of doing that. Essentially, he says you don't have to break up the institutions themselves, but you definitely have to parse off the amount of what he calls these boring assets, which are other people's money, the deposits made by the bank customers that are supposed to be savings deposits and not speculative money for the casino, and kept separate from what the bank uses as its risk and speculation capital. And that risk and speculation capital has to be something that they have to hold very high quality reserves against so that they can liquidate and create cash when they get into trouble and self-fund when they're in throes of liquidation panic, instead of always turning to the taxpayer for the bailouts. So right now, that's going to happen again because the system hasn't been fixed or reliquefied. In fact, it's been more indebted, more derivatives, more leverage. So when we get into the next panic, which is inevitable, it will be again that bankers coming hat in hand to taxpayers, threatening the governments that if they don't get free money and bailed out, that the whole world's going to come to an end. So we're going to get another opportunity to revisit our response and our solutions and strategies here. And he's just doing a lot of the work. And as many authors have been, some very good sober thoughts have been penned, and hopefully will prove to be a roadmap, so to speak, of how to get out of this mess when the next big crisis returns.
In Britain, a number of ex-Barclays Bank traders have been jailed for 2 to 6 years for taking part in the Libor fixing scandal. Is that enough to discourage people from doing that?
It's certainly a great start. Now, there'll be appeals and things, and, to what extent they end up serving actual time. But I'm a big proponent of where there's convictions for white-collar crimes and fraud. I think they should be taken very seriously. In the deterrence aspect, I would suggest to you, when you're talking about people with resources, which many of these people from the finance sector have such greater resources available to them than the average person, the only significant deterrence, in my view, is where you strip them of their rights and privileges, where you say that they do have to do jail time and remind themselves that they are just under the rule of law like everybody else. And without that penalizing through that kind of penalty, I don't think you get their attention. Fines, which they can write checks for, is of really no import. You really have to strip them of their rights and liberties, I think. And again, for people that are prosecuted correctly and found to be actually criminal in their actions, for sure.
Well, J.P. Morgan has been fined billions of dollars for mistreating mortgage holders and so on, and yet they were the most profitable bank in the U.S. in the last half a year.
Well, they should be, because they have every possible advantage and every possible unfair advantage thrown their way, thanks to regulators that they are basically calling the shots for, thanks to politicians which have queered the rules in their favor, thanks to the breach of every law on the books that they routinely have broken, and they've been shielded by their army of lawyers and accountants who fend off any serious accusations. So yeah, they get away literally with murder all the time. And then the really corrupt aspect of that is that the business media, who is also sponsored by these same culprits, praises them as genius for their, quote, record-beating earnings reports. And it's really a farce beyond anything you can really imagine.
The Dow Industrial and S&P 500 are at record highs. Are they sucking people into a disastrous investment?
Well, that's another interesting aspect of this, because the actual flows, the money flows have been coming out of equity markets for, many quarters, really all the way back to 2010. And yet you see the, headlines, the S&P and the Dow hitting these new peak levels. Now, if you look at who's participating, we know that it's this, mindset of the Citadels of the world, the high-frequency trading shops that have been running on all this liquidity that is pumped into global markets through the central banks. And, this week it was quite ironic or poignant when former head of the FOMC, Ben Bernanke, who's now paid consultant for Citadel, one of the biggest HFT front-running firms in the world, went over to meet with the head of the Bank of Japan to counsel them further on how to employ more quantitative easing. Now, if you remember, Ben Bernanke was the scholar or the academic that first wrote papers on after the Bank of Japan and the Japanese economy blew up on the credit bubble in late 1989, property markets imploded, equity markets imploded, everybody lost their shirt. So what they did was they said, Ben Bernanke started saying, you better start using central bank printing basically to buy up assets and try and create inflation through this procedure he called quantitative easing. So anyway, that's been he's been the architect of this disaster from the beginning, and now he's left office as I say, as the head of the FOMC, but has gone to work for HFTs who are trading on this vapor and madness in world markets, liquidity spewing and all that sort of thing, and he's over there counseling the Bank of Japan, probably to get information on what assets they're planning to buy next, so he can come back and report to Citadel, his now employer, about how they can rig their algo systems in order to take advantage of this trading, which they can now anticipate based on him advising the bank. You really cannot imagine how misguided and corrupt this has become. I really can't think of another period, and believe me, there's lots of periods in history where humans have, gone down this path where people will take unfair advantage, and when they're allowed to break the laws, do all these things. But the scope and scale of this episode is unlike anything I've ever studied in history. It is really remarkable. So I think we should expect that the correction phase will be larger in scope and scale than anything we've seen before. So you're talking about something between easily the kind of loss cycles that we saw in 2000, 2008, and somewhere between that, perhaps, in the loss cycle we saw in 1929, which was an 89% drop in the price of these so-called broad blue chip stocks. So somewhere in there would be entirely appropriate given the maniacal stuff that's gone on and the amount of leverage and debt and abuse that's happened in the world. So I guess the thing is, you can't lose your mind with this episode. You can't convince yourself that math doesn't matter, that valuations are irrelevant, or that solid investments are to be found in everything trading at all-time highs, because that's really just kind of going temporarily insane, and you will lose money with the masses, and you will deserve to lose money with the masses if you allow yourself to, it's like a brain fever that has overcome people. And so, if you want to look for smart things to do with money today, I was writing about smart investment in energy infrastructure and your own, investing in things that help the real economy to be more efficient, to be more protective of the grid that we have, to produce power in every passive collection mechanism available in homes, businesses, and governments. Those are the kind of smart investment things that people can be doing today, things that lower their monthly expenses, make them waste less, whether that be by paying off debt and having less interest costs coming out, by lowering your as I say, your expenses. All those things make a lot of sense, and if you have savings and capital and you're looking for places to put it, you can do all sorts of intelligent things like that. The other thing is that, you can store your savings, build up your savings, and be ready for this opportunity that's coming, because I'm quite sure it will come. It's like a mental drip, drip, drip to see if you're going to succumb to the fever before the fever breaks, and it's the people who don't lose their mind in this episode that will be in the best position to prevail.
Brexit, they say it's going to cost the Canadian economy 0.1% of the GDP. Is it really something for us to worry about?
Well, it's, let's put it this way. The world's been in a slow growth phase now for the past 15 years, and nominal GDP, for example, in the U.S. economy has been well under 4% for some time now, and that's always been indicative of a recession in that economy. The world's global growth rate is much lower, about less than half of what it was in the preceding 15-year period. So all of this was already extraordinarily weak. This nonsense about Brexit this is just an excuse that the mainstream will seize on, or the policymakers will seize on, as a to deflect the responsibility from the places and people that it actually belongs in. So this episode of great fragility in the world was earned by the abuse of credit and by the laxing of all the lending standards and allowing securitization of all this garbage and selling it as, quote, investments. That's what the real problem has been. And there was always going to be any spark at all. That's the whole point. When you get a system so weak and fragile, gutted of real investment and actual savings, and all levered out, strung out on these crazy derivative instruments, when you get that kind of an environment, the slightest thing can cause, you never know exactly what combination of factors are going to spark this meltdown, but basically anything that comes along, because there's no resilience in the system. So Brexit is just we need disruption of the status quo. It's got to come because it's so unhealthy in its current form. Breaking up of political unions has got to be part of this, because we've had this period where everything was consolidated and power extracted to the top. Now we need to go back to more of a localized model. And I think that Brexit is, of course there's some unknowns there. Of course they're in the midst of transition. They just got the new Prime Minister announced yesterday. They're going to have to revisit the trade agreements. But as I wrote in our month-end letter to clients last month, with the world in such a thirst for growth this is well before Brexit, right? All this stuff, all this sluggish growth, everything that I'm talking about, the downturn in revenues, everything that's gone on in the world is nothing to do with Brexit. That was way before that. And so yes, this Brexit perhaps in the next year or two will not be an addition to world growth, but there's zero chance that the world doesn't want to do lots of trade with Britain. Let's face it, it's one of the wealthiest economies in the world, relatively the wealthiest households in the world, and in a place where everyone's desperate for sales. So of course the rest of Europe's going to want to trade with Britain, and they're going to want to get to the bottom of this. I think we've been through this period of great, fear mongering of the status quo, saying you guys better not do this or else the end is near. And the fact is, as I've said, the end has been, the end of this erroneous destructive model, which the status quo has counseled to everyone in the past 15 years, is really what we're talking about. We're trying to get an end to that. And to say that we're going to be in financial trouble or the world's going to enter recession if they go through Brexit is just farcical nonsense.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park. Check out her blog, Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions for the show to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.